Hi guys, Max here, and this is your daily market update for yesterday, the 28th of June. Now, as you can see from this graph behind me here, equities were really not too happy. Big tech in particular performed really quite awfully. Amazon and Tesla both down by about 5% each. Google, Microsoft and Apple down by around 3% each, and then most other sectors didn't perform well either. Financials weren't great, industrials, healthcare, real estate, consumer defensives, nothing really performed well except for, of course, oil. As you can see here, the oil sector went up and was the only green sector for the day. The answer for that, the reason for that is really quite simple. Oil prices rose once more. As for the indexes then, how did they actually perform in nominal figures? Well, the S&P 500 fell by 2%. The Nasdaq underperformed, as you can imagine, from this big tech movement, and it fell by 3.1%. The Dow Jones fell by 1.6%, just doing a touch better. Now, in the rest of the world, it was actually cautiously better a little bit. In Europe, it wasn't awful. In Americas, it wasn't awful. And in China, it wasn't awful either. The FTSE 100 was up by 0.8% for the day, and the Stoxx 600 was up by 0.3%. On the whole, though, the American equity market being so massive, the MSCI World Index still fell by 1.3% for the day. Now, the reason for this is quite simple. We got new consumer confidence data out, and it's really damn dire. And so the markets are very worried about that, but more on that in a moment. For now, what happened in the world of currencies? Well, as we see so often these days, when economic data looks poor, the dollar rises as a hedge, as it's just safer than any other currency in the world. And so the dollar spot index rose by 0.4%. The euro fell by about 0.5% and is back down to $1.05. The pound fell that same amount and is back down to $1.22. And then the yen fell that same amount as well and is now at 136 yen per dollar. In the world of fixed income assets then, what happened for bonds? Well, the US 10-year Treasury yield lost a small amount of its yields, down by 2 basis points for the day. It's currently at 3.18%. In the rest of the world, though, in Europe, for example, bonds actually saw outflows with yields rising. In Germany, the 10-year rose by 8 basis points, and in Britain, the 10-year rose by 7 basis points. Now, as I mentioned earlier, oil prices rose, which is why energy stocks went up. And so WTI crude, well, it rose by about 2% to $112 a barrel. Brent crude is a touch higher, as always, at $115 a barrel. Now, this shouldn't really be too surprising. We have been expecting this return to that sort of free market level of about $120, as the downwards pressure on oil over recent weeks has really been a result of speculation as opposed to real market forces determining demand and supply for oil. Finally then, for conventional markets, what happened with gold? Well, there wasn't much movement at all, but gold prices did fall very slightly. They're sitting at about $1,821 an ounce right now. Finally then, what happened in the crypto market? Well, as you can see, it wasn't very good, and actually this time it wasn't very good. Bitcoin was down about 5% and is just a touch below $20,000 at the time I make this video. Ethereum did a fair bit worse and is down 9%, around $1,100. Most altcoins underperformed the bigger coins. They're down by on average about 10 or even more percent for the day. Now, I'd love to say that there is a specific reason for this drop, but really there isn't. This may well be connected to the same consumer confidence report that we had that impacted traditional financial markets. Crypto has shown quite a strong correlation with risk on equities, so this could be that same sort of effect there, but really we don't know. This is just the crypto market. It's in a really bad space right now. There isn't much optimism, and it's losing investors by the day. So as I mentioned just a moment ago, this new consumer confidence report came out and it's pretty dire and it's really shaken a lot of investors. And so that's really why markets fell. Before this data came out, actually equities were performing okay for the day, but then they sort of dropped off a cliff. Now, the idea behind why markets reacted so negatively to this news is really quite simple. When consumer confidence is poor, where people aren't confident about the economy, about their job security, about interest rates and their mortgage payments and car payments staying low, well, they spend less money. That results in business earnings falling. That results in layoffs. It results in a bunch of different positive feedback loops, which basically mean that a recession is going to come, because usually recessions are demand driven. They come from consumer actions, as opposed to the recession we saw back in 2020 when it was lockdowns and supply driven, that everything just shut down. Now, this passage here from this article pretty much explains it perfectly. Data released on Tuesday morning showed the Conference Board's Consumer Confidence Index dropping to its lowest point since February 2021, with near-term expectations reaching its most pessimistic level in nearly a decade. The growing gap between the Conference Board's current situation and then their expectations have widened to levels that often precede a recession. So yeah, people are very worried about the economy right now. The markets are performing really poorly already. This is so far the worst first half of a year since 1970, over 50 years ago. This is the first time we've had 2 consecutive quarterly falls in the indexes since about 2015, and obviously it's much worse than it was back in 2015. A recession is widely expected, and markets are unhappy about this, and every time new data comes out suggesting that actually it's getting more and more likely, well, markets are going to keep falling. Now, we did get some news regarding the London Nickel Exchange, London Metal Exchange nickel short squeeze and that whole kerfuffle which happened a few months ago now. Now, basically, it was a huge story that the London Metal Exchange saw a big short squeeze. The exchange was shut down to protect one of its biggest investors, this Chinese short seller firm, which found itself on the wrong end of a trade. And at one point, it had paper losses of over $10 billion. But basically, all the banks that supported this investing firm manipulated the markets to protect them. The London Metals Exchange shut down the nickel markets for over a week so that they couldn't get margin called and things. Banks like JP Morgan rolled back trades that had been made at super high losses just to help this company. They then helped them reduce their short position. Basically, loads of money was lost, including a lot by the banks. JP Morgan took about $120 million worth of losses, but they have finally announced that they are out of exposure. They no longer have anything to do with this, so their pain in this scandal is finally at the end, and this is good news for any JP Morgan shareholders. We have another bit of small news regarding geopolitics. I know I always get crap whenever I talk about this, but this will impact markets in the long term. This time, it's about Turkey and Sweden and Finland who want to join NATO. Now, over the last couple of months or so, Sweden and Finland have made it clear that they want to join NATO after the war, after Russia invaded Ukraine. Turkey had been holding this up, exercising their veto to this, basically making a bunch of demands. A few about the Kurdish groups that they want listed as terrorist groups in Sweden and Finland, and then a couple of other things as well. But news has just come that actually Turkey is going to allow, they're going to stop using their veto, and they're going to get on board and allow Finland and Sweden to join NATO. Now, why is this important? Why are we talking about this? Well, for the same reason we spoke a little bit about geopolitics yesterday. This is bad for relations with Russia. Russia will obviously be unhappy about this. They've threatened Finland and Sweden with war. They invaded Ukraine. One of the reasons they invaded was because Ukraine was becoming closer to the West, and they didn't like that. They did the same thing with Georgia in the past when they wanted to join NATO. This is going to make Russia very unhappy. You can best believe that further threats will come from Russia towards the West as a result of this. Sentiment between these two countries, East and West, is going to fall. Tensions are going to get worse. Sanctions are going to stay in place, and the war in Ukraine is going to continue. You best be betting then that commodity prices are going to continue to be impacted by this conflict and by the port tensions and the sanctions. Corporate earnings are going to continue to be impacted. Those companies which want to re-enter the Russian market, well, they're going to struggle. Consumer sentiment is going to continue to be impacted as well. War is bad for people. People don't like war. They don't feel very comfortable when there's a war on their horizon. And so all of this will have long-standing, really major problems, and it will have wide-ranging effects on the economy and on financial markets into the future. Now, regarding some corporate news, we've heard from Pinterest that their CEO, who's been with the company for about 10 years, is going to be stepping down, and a new CEO is going to be rising to the task. Now, Pinterest is this sort of tech social media company. It was very hyped up on YouTube by people like Meet Kevin over 2020 and 2021. But like every other tech company, well, it's been absolutely hammered recently, including in the latter half of 2021 even. Its share price is down about 77% at this point right now from its all-time high. There have been huge losses across the board. They basically saw some really big major gains in users and growth during the pandemic, but they struggled to maintain those positive effects as the pandemic eased, as lockdowns stopped and people went back to their normal daily lives. Confidence in the CEO has waned. He's been with the company for 10 years, but its last 2 years have really been a bit of a struggle. So he's stepping down and they're getting a new CEO who comes from a Google and PayPal background, who is by all accounts a very competent man. And people seem to be quite confident about this move. After hours, Pinterest's stock price is up about 4%. So this is probably good for any bag holders there. In a little bit of contrast then, Disney is doing the opposite thing. Its CEO has had his contract extended by another 3 years. It was due to expire in about 7 or 8 months, I believe. Now, Disney's share price has also been absolutely hammered because it started to get valued sort of as a tech company as Disney Plus came out. It's down by more than 50% right now. But they're going in the opposite direction and they're sticking with their CEO. And in fairness, Disney has been far more successful than Pinterest. They haven't been hit nearly as hard as Pinterest. Disney Plus has been an absolutely magnificent, huge success. And so they're very happy for that. And so why would they be getting rid of their good CEO just because markets as a whole have been performing poorly? Finally, then, the last thing to talk about here today is that China might be on the brink of abandoning zero COVID, or at least taking it to a lesser extreme. Now, the actual news we have is that the quarantine time for people traveling into China has been cut in half. The markets love this for obvious reasons. They think it means that there's going to be greater economic growth in China. They think it means that maybe other things are going to be loosened as well. Maybe factories will stop getting shut down. Maybe ports will be able to operate at full capacity even when COVID is around. This should be good news for the supply side crisis. But the Communist Party is, of course, claiming that they're not loosening, that they're not actually easing restrictions or anything. They're trying to make this as a smaller deal as possible, probably because they put so much credence into the zero COVID idea and they don't want to be seen losing faith. Maybe this situation will continue to evolve in that way. Maybe China will continue to ease their restrictions to make things a little bit easier for business and to stop taking COVID to this massive extreme. Let's hope it goes in that direction, because if it doesn't, well, the supply side crisis is going to continue on into 2024, 2025 even. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.